So you're probably wondering, what on earth is private equity? How does the private equity industry make money? And why is there such a bad representation about private equity, which is portrayed by the media? Now, I'm going to debug this. I'm going to explain exactly what private equity is and give you a real high-level overview so that you can go into your interviews and you can have a full understanding of private equity. So, overview. What exactly is private equity? So, in essence, private equity is what we call an alternative asset class. This is because it invests in private businesses. So it collects a pool of money from a multitude of investors and uses this money to invest in private companies that hedge funds, asset managers cannot invest in. So let's go into the fundraising cycle of private equity. Now, in private equity, they have different funds. Now, a fund is a pool of money from a bunch of investors. Now, these investors can range from wealthy individuals, pension funds, sovereign wealth funds. All of these different people will contribute and put money into a type of fund. Now, funds can be an enterprise fund where it's a little bit smaller. For example, it could have around 500 million assets under management, or it can range even as high as 1, 2, 3 billion. This is mid-market that I'm talking about. And the way this money is given to private equity funds is it's drawn down. So when the private equity fund finds a business that they're interested in, they will ask the investor for the money, it will be drawn down and it will be placed into this asset. So that's the fundraising process of private equity. Now, how on earth do you find a private business to invest in? Now, this is where private equity is really, really smart and has a lot of different relationships. In private equity, you have relationships with advisors, you have relationships with other PE firms, and you'll probably have a direct origination function sat within the company. So let's just lean on the advisors first. Advisors will speak to private equity firms, will speak to the investment team and say, we have this investment, this business, it's going up for sale, I think you might be interested in it. I think they also like your private equity firm. This could be a one to invest in for you. Secondly is other private equity funds. Now, in private equity, it's not uncommon to buy one of their assets, and this is called a secondary. So you can quite often get private equity firms buying assets off other private equity firms, and this is how you will find another private business. And thirdly, a direct origination function is where a team within the private equity house or outsourced will come up with different firms that they have found in the market, and these are typically primary deals. So deals which hasn't had any private equity investment, hasn't had any venture capital investment before. Now, once you've found this private business, how on earth do you go about purchasing? And this is quite a common question which is asked in private equity. Now, in order to purchase it, in private equity, you have a mixture of debt and equity that is put into the business. You would typically have about 70% debt and 30% equity. So we've now found this business. The investment team will do a lot of due diligence. They'll look at the financial statements. They will look at FDDs, CDDs to figure out, is this actually an interesting business? And they'll be meeting the management team. But as soon as they have, they will put a bit of equity in, they will get some debt from a commercial bank, plough this into the company, and then after a few months, it'll be purchased. Next is the holding stage. Typically, in mid-market private equity, you'll be holding assets between 3 to 5 years. And the reason it's held between this amount of time is to try and drive as much value out of the company as possible and make positive change, so that in 3 to 5 years' time, you can sell this for a high money multiple. This money multiple can range between 2.5 times to 3 to 4 to 5 times on some absolutely stunning assets. So it'll be held, strategic decisions will be made, there'll be organic, there'll be inorganic growth, and this business will grow and grow until it's about to be sold. Now, what are the exit opportunities in private equity? In mid-market private equity, there's two, quite frankly. The two are, you either sell to another private equity fund, and this is, as we talked about earlier, our secondary, or it can be sold to trade. Now, when I'm referring to trade, I mean a business that is in the same vertical as the business you are selling. So, for example, if we have Google and Google is looking to buy other firms similar to that, they can come across this firm that they really like, that is fully owned by private equity, but they will buy that firm off the private equity firm. And that is what we essentially call a trade deal. Now, in very rare circumstances, and it doesn't happen in mid-market private equity too often, but you could have the company IPO, that is an initial public offering. But as I said, this is very rare, and this only comes really from the big board bracket private equity firms such as KKR, EQT, so on and so forth, or venture capital firms which are just buying firms small and try to drive value to that IPO valuation. So let's summarize. Private equity is when we have investors, they pool money into a fund. Investors can be pension funds, they can be asset managers, they can be wealthy individuals, and this money is then held by a general partner who will make investments on behalf of them into private businesses only. And then with these private businesses, they'll go through organic, inorganic growth, drive value. In 3 to 5 years, the business will be sold, the fund will be closed, and their money multiple of 2.5 to 5 times will be returned to the investor. So that is private equity summarized in a short time as possible. Now, please be sure to follow this series because I'm going to be talking about the fund structure in private equity, I'm going to be talking about the management fees and the performance fees, and I'm going to be talking a little bit about the salary. So make sure you subscribe and like the video for even more content. Thanks for watching.